Hey, how's it going? I'm Daniel Kelchner.
Hey, I'm Leo Martinez.
Ryan Aaron.
Emily King.
你好，我叫张明哲。
Alright, pause it. Sorry.
Hey, how's it going? We're Group 5. My name's Daniel Kelchner.
I'm Leo Martinez.
I'm Emily King.
Ryan Aaron. What's up?
How's it going? We're Group 5. My name's Daniel Kelchner.
I'm Leo Martinez.
I'm Emily King.
Ryan Aaron. What's up?
Purpose of budgeting. Budgets help businesses plan for the future. They help identify any expenses and revenues that may be incurred during that period, as well as provide a benchmark of where the firm can go. This is important because it helps firms develop long-term goals for the future, such as purchasing additional equipment or even a new plant. In addition, it gives managers the power to identify problems in the budget and revise it accordingly so the budget will always be as accurate as possible.
The financial budget is another key component of the master budget. It is created by preparing different types of budgets, such as a cash collections budget, capital expenditure budget, and a combined cash budget. A capital expenditure budget determines whether or not a firm should make a capital investment, such as an investment in new property, plant, or equipment. A cash collection budget focuses on when the company is expected to receive cash from sales and credit sales. Companies will receive cash immediately when dealing with cash sales. However, companies will receive cash within 1 to 30 days when dealing with credit sales. Unfortunately, not all money from credit sales will be received within 1 to 30 days. In order to make the cash collection budget more accurate, companies will only record a certain percentage of total credit sales as cash received. A cash payment budget shows what the company will pay for its direct materials, direct labor costs, and various other costs. In order to get the company's ending cash position, we combine the budgeted cash collections with the cash payments budget. This gives us the combined cash budget. Once these budgets have been created, we can prepare a balance sheet. It will include assets such as cash, accounts receivable, property, plant, and equipment. It will also include liabilities and stockholders' equity, such as accounts payable, income tax liability, and stockholder equity.
Many companies use budgeting and forecasting software for efficient performance. This software is designed to provide planning and solutions for the business. Examples of some software are Hot Analytics, Quantrix, Cengage, the Budget Maestro and Planning Maestro, and PlanGuru, which is a more affordable program for smaller companies. These programs are designed to assess and monitor the productivity of a company so that they can make better, more informed decisions for the future. They handle flexible budgeting and planning, they provide confidence in numbers, and interactive presentation options for meetings. They provide easy data transfer between company computers, and they save the accountants the hassle of spreadsheets. They can integrate balance statements, income statements, and cash flow statements for comparison, and they are compatible with most Excel and QuickBooks programs. How are the master budgets prepared? The master budgets consist of the sales budget, the production budget, the direct materials budget, the direct labor budget, the manufacturing overhead budget, the operating expenses budget, and the budgeted income statement.
The sales budget is the starting point in preparing the master budget, and it is constructed by multiplying the budgeted unit sales by the selling price. The production budget is prepared after the sales budget. It lists the number of units that must be produced to satisfy sales needs and provide for the desired ending inventory. A direct materials budget is prepared after the production requirements have been computed. The direct materials budget details the raw materials that must be purchased to fulfill the production budget. The direct labor budget shows the direct labor hours required to satisfy the production budget. By knowing in advance how much labor time will be needed throughout the budget year, The company can develop plans to adjust the labor force as the situation requires.
The manufacturing overhead budget is a detailed budget of production costs. It excludes the direct labor and the direct materials budget, and it anticipates for manufacturing purposes for a specified period. The operating expense budget forecasts all the elements of a business, including operating expenses such as salaries, rent, depreciation, and others. The budgeted income statement consists of the sales revenue minus the cost of goods sold, which is the number of units sold times the manufacturing cost per unit, which equals the cost of goods sold. The sales revenue minus cost of goods sold equals gross profit, and then you subtract operating expenses to find the operating income. From there, you subtract the interest expense and the income tax expense to find the net income.